Have you ever stopped to wonder what really drives the value of global money? I mean, is it politicians, banks, a return to the gold standard? Every single day, literally trillions of dollars change hands across the globe, but the invisible gears turning that massive machine are often misunderstood. Well, today, in this explainer, we are unpacking exactly what moves the needle in the global foreign exchange market.
Okay, let's dive into this. Welcome to the Explainer. Today we're looking at the mechanics behind the world's major currency pairs, drawing on some deeply detailed survey data from the Bank of International Settlements. We're going to decode the specific levers, everything from central bank interest rates down to physical barrels of oil that dictate how the top 10 most traded currencies behave on the world stage.
So here's our roadmap. We'll start with the foundation, take a look at the heavyweights, move into the commodity connection, explore safe havens and geopolitics, and finally, wrap up with crosses and emerging markets. All right, Section 1, the foundation, the global tug-of-war. Before we get into the heavy hitters, we really need to get a grip on the basics. You see, currencies don't just exist in a vacuum. They're always traded in pairs. A currency pair is simply a pricing structure where you buy or sell one currency while automatically selling or buying another. Think of the Forex market as a constant global tug-of-war. The value of one side only really matters in relation to the weakness or strength of the other side.
And the way this pricing structure is built is actually quite brilliant. First up, we have the base currency, which always appears first. Then you have the quote currency. The price you're looking at on a trading screen represents exactly how much of that quote currency you need to buy just one unit of the base currency. So using a quick hypothetical, if the euro to US dollar pair is priced at 1.20, it literally means it takes 1.20 US dollars to buy one single euro.
Now, to make sense of the hundreds of combinations out there, we can categorize the market into three main groups. First, you've got the majors, which are the most traded globally. Next are the commodity pairs, whose value is heavily tied to raw materials pulled right from the earth. And finally, crosses. These are highly traded pairs that simply bypass the US dollar altogether. Moving right along to Section 2, the heavyweights, interest rate mechanics.
Now, what's really fascinating here is the sheer scale of market dominance. Based on 2019 data, just three pairs dominate nearly half of all daily Forex trades globally. The euro and US dollar capture 24%, the US dollar and Japanese yen sit at 13.2%, and the British pound and US dollar take up 9.6%. These are the undisputed heavyweights of the global financial system.
But what actually moves these massive global pairs? Well, the underlying mechanic here is interest rates, and the central banks are the ones pulling the strings. Huge institutions like the European Central Bank, the US Federal Reserve, the Bank of Japan, and the Bank of England set these vital rates. The core logic is simple. Higher interest rates generally yield a better return on investment. So if the European Central Bank sets higher interest rates than the Fed, demand for the euro typically goes up relative to the dollar. It's fundamentally a battle of central bank rate differentials, meaning the gap between their interest rates.
Let's move to Section 3 and see how this builds. The commodity connection, resource mechanics. You know, some currencies literally have their gears turned by raw earth materials. Take these two, for example. On one side, the Australian dollar, often called the Aussie, is intrinsically tied to metal and mineral exports like iron ore and coal. On the other side, the Canadian dollar, affectionately known as the loonie, is deeply linked to the global price of Brent and US crude oil. Let's look closer at the Canadian dollar to see exactly how this micro-narrative plays out. Oil is priced in US dollars globally, right? When oil gets expensive, it usually weakens the US dollar because you need more of them to buy the exact same barrel. But here is the catch. Canada earns a massive supply of US dollars through its oil exports, so higher oil prices literally flood Canada with US dollars, which subsequently strengthens the Canadian dollar against it. It's this fascinating, automatic relationship where the commodity directly dictates the exchange rate. On to Section 4, safe havens and geopolitics, crisis mechanics. When the world gets volatile, the market reacts mechanically. The Swiss franc, for instance, historically acts as a safe haven. When global markets get unstable, investors shift their capital into the Swiss financial system for safety, causing the franc to strengthen. Conversely, the Chinese yuan fluctuates heavily based on trade tensions. During a trade war, a government might purposefully allow their currency to depreciate to make their exports cheaper, boosting their market share globally. So the crucial point here is that human events drive concrete numerical changes. Just think about this number, 3.3%. Between 2016 and 2019, the daily trading volume of the US dollar to Hong Kong dollar pair didn't just inch up, it more than doubled, jumping from 1.5% to a massive 3.3% of global transactions.
And this massive spike wasn't just some random anomaly. In 2019, geopolitical events, specifically the intense protests in Hong Kong, created an enormous amount of media speculation. Even though the Hong Kong dollar's value is strictly locked or pegged to the US dollar, the sheer volume of global attention physically drove up the trading volume of the pair as traders closely watched the volatility unfold. Basically, news translates directly into market action.
All right, Section 5. Crosses and emerging markets, new frontiers. Remember those cross pairs we talked about earlier? The euro and the British pound is a prime example. Despite completely lacking the US dollar, it remained the 9th most traded pair in the world. Why? Well, it's the sheer economic proximity and deep trade ties between the UK and Europe. But notably in recent years, its high volume has been heavily driven by the unpredictable fluctuations surrounding Brexit. Volatility attracts volume, plain and simple.
And then we have the rising powerhouses. You might have heard the famous phrase, the miracle on the Han River. It describes South Korea's absolutely massive economic growth since 1953. Because of this phenomenal, long-term national development, the US dollar to South Korean won pair actually broke into the top 10 most traded global currency pairs for the very first time in 2019. It is a true testament to how shifting global power dynamics literally rewrite the top 10 list.
Finally, Section 6. Conclusion. Mechanics in motion.
We've seen how central banks, resources, and human events turn the gears of the world's money. So how do you actually make sense of all this noise? Understanding the mechanics of these top 10 pairs requires combining two vital steps. First, perform fundamental analysis. This means assessing exactly what we've talked about today: central bank rate announcements, geopolitical disputes, and global trade flows. Second, perform technical analysis. This involves looking closely at the actual market pricing charts and historical trends to see how those fundamental facts are physically manifesting in real time.
We live in a highly interconnected global economy. Which brings us to a final thought. With central banks adjusting rates, commodity prices swinging, and geopolitics constantly shifting, which mechanic do you think will drive the next big market move? When you watch the news tonight,